Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thank you for being with us. The Fed has spoken and, for all intents and purposes, signaled that there is no end to this current tightening cycle. So what did they say, and where are we headed with inflation and, of course, the prospects of a recession? We're going to discuss that right now with my guest, Michelle Schneider, Managing Director of MarketGauge.com. Michelle, it's always nice to have you on the show. Couldn't be more fortuitous considering that we just heard from the Fed, the meeting that took place on November 2nd. We know by now that the FOMC has raised rates yet again by 75 basis points. But Powell added that it is sufficiently restrictive to return inflation to its 2% target at this time. So that was a really bold statement. So what do you think the Fed is saying here, Michelle? And you think there'll be some smaller hikes coming maybe as soon as December?
Well, first of all, I think that the credibility of the Fed has declined, and this is precisely one of the reasons why. The same person who was saying that inflation was transitory is now giving the market and the economy no time to digest 4 rate hikes in a row, which is historical. So the fact that there's been a total lack of patience, too much patience initially, and now a complete lack of patience, means that whether or not they decide to increase further into December, and then finally we'll have a blackout period as we get into 2023, remains to be seen. I just think that whatever they do right now, other than the fact that they are killing certain aspects of the economy and possibly driving us into a recession, it's pretty ineffective in the long run in the type of inflation that we're going to be seeing as we get into 2023.
You know, and Michelle, just to expand on that a little bit, Powell made a comment about the soft landing, quote unquote, for the economy, basically saying that the window for a soft landing has narrowed, but that it's still possible. It's interesting that he said that kind of thing, because he also went on to say there's no sense that inflation is coming down. He even said that no one is sure if a recession is going to happen or not. So what are your thoughts on inflation and the prospects of a recession for the U.S. when you look at the data that the Fed is looking at?
Okay, so first of all, Christine Lagarde, I just want to add, also said today that she doesn't think that putting economies into recession is going to do anything to fight inflation. I thought that was a pretty bold statement coming from her, and I was surprised that we didn't see more of a reaction. But essentially, here's what's going on. There are certain aspects, obviously, that the Fed is going to continue to watch. One is the labor market. And at the time you and I are talking, the jobs report will be coming out in 24 hours. And if that looks pretty strong, and again, I think they're selective in how they look at things. The JOLTS report showed there were more openings. We know that Amazon and a whole bunch of other companies are talking about layoffs. But nonetheless, if this very lagging indicator turns out to look good, they'll say, you see, the labor market is still strong. The housing market, obviously, we've done a tremendous damage to the housing market in essence, but if you go back in a 3-year period and you adjust and not look at it year to year, it's not that bad. There's still a big demand, especially in rentals right now, as opposed to purchases. So I think what the Fed might be missing, or at least not talking about, that Lagarde referred to, is that there are certain things we can't control. Probably top on the list is geopolitics. So right now, as we're talking, we've got issues potentially with North Korea, with Iran. The Ukraine-Russian situation continues to march on. And so you have to say, at what point do any of those things erupt further? Number 2, obviously, we have some real weather issues still with drought or floods, depending on where you are. Number 3 is we still have highly elevated food prices. That doesn't look like that's going to be going down. We're actually starting to see some hoarding in places globally, which could turn out to be something here in the U.S. And we still have energy issues on top of that. Plus government spending, and not just here, but sovereigns all over the world right now, aware of the recession, are trying to spend money to elevate their economy, which of course we know is inflationary. So these are the things that the Fed, I do not believe, can control unless they kind of do a Volcker thing, and I don't think that's going to happen. And if anything, if we start to see more economic data pointing south, if they start to actually diminish the rate of change of their hikes, that could wind up being very inflationary as well.
Right. Yeah, I mean, we did have the JOLTS job opening data come out, and it showed a rise of about 500,000 jobs. So there's still heat in the jobs market. Obviously, as you said, Michelle, at the time we're talking right now, we're 24 hours away or a little less from the unemployment number for the month of October. So we'll really be keeping an eye on that. But it sounds like from what you're saying, we've got still shutdowns in China with no end in sight. At least the country hasn't said when they might end those. We've got the conflict in Ukraine, rising gas prices. It doesn't sound like you think inflation has peaked here, but I will ask you that question. Have we peaked, or do you think there's still room to go higher when it comes to these inflation levels?
Again, I think it depends on where you look. If we're looking at things like the car market or things that people don't necessarily need, perhaps we've peaked there. Obviously, with these rates, it seems like that would be a good conclusion. The things that rates can control, like geopolitics and food and climate and energy, and if we have a bad winter, no, I do not think those have peaked. And if anything, I think once people start to realize that the banks and the sovereigns can't control the situation, we could then get into a place where currencies, including the US dollar, goes down. And then we really have almost a chaotic situation, which, by the way, Yellen has hinted at when she said the financial stability is at risk. You don't want your Treasury Secretary saying things like that.
Yeah, exactly. Well, and here's the million-dollar question, and there's some debate out there. Do you think that the Fed acted fast enough? A lot of economists contend that they should have probably started tightening sooner than they did, which may had the effect of curbing the spikes in inflation that we've seen.
Absolutely. I mean, and we can go back to 2017, 2018. They almost did it in 2018, but when they saw the reaction of the market, they hit back. And of course, after COVID, when they did all the stimulus, and they really did most of its QE, once things were stabilizing in 2021, that's when they should have started doing some rate raises, but they didn't. So they waited too long.
Terrific. So as we're getting into the final part of our conversation, I have to talk about midterm elections with you that are on November 8th here in the U.S. Just wanted to get from you what your expectations are for the markets. Obviously there's expectations of potentially a mixed Congress. So what sectors are you going to keep an eye on? Which are the ones you're most concerned about, depending on what the results could be?
Well, actually, if you look at the statistics historically, midterm elections have had a relatively muted reaction in the markets, which brings back what's the most important thing right now is what the Federal Reserve does. But let's assume right now that we have also seasonally things in our favor. Usually this is a good time of the year. Midterm elections, when we've had a Democratic president, if the House goes Republican, and that kind of gridlock has been historically positive for the markets. So let's say that happens. Where would I look right now as far as investments? Well, there's a couple of things that I think you really want to see first. One is the long bonds, which I really believe now, if we are going to get into any kind of loss more of credibility of the central banks or what have you, we could actually see long bonds lowering yields, which means the TLTs go up. Two is the dollar. Obviously, a lot of instruments are sensitive to the US dollar, which had a nice pop, but still may have peaked. If that goes down, I think you have to look again at the commodities markets, particularly those very lagging precious metals, although silver has been doing incredibly well relative to the gold. And then I think you have to look at these small caps because they have been outperforming. They led the rally up to this point. And even after the big down move post-Fed, they've actually been sitting there right on a very key moving average. So if they hold up, I think then you could start looking at why the Dow's moving up, which is some of those blue chip industrial manufacturing sectors are somewhat optimistic, and probably the best place to find optimism in terms of any possibility of a soft landing.
Terrific. Michelle, I know there's a lot to talk about in such a short amount of time. We've got so much uncertainty. We're still in the middle of earnings season. There's a lot more important economic data to come that the Fed will be looking at as they are data dependent. So we'll have to have you back before the end of the year to really take a look and see where we're heading into 2023. But it's always a pleasure to see you, my friend. Thanks, Michelle, for joining us. Good to see you.
Thank you so much, Anthony.
Anytime. We'll see you soon. That was, again, Michelle Schneider, Managing Director from MarketGauge.com.